Good afternoon, and thank you all for staying with us this afternoon for the session on how private credit is shaping up in Asia. So we have with us, thank you for coming on, a distinguished panel of speakers. I will do a very brief introduction of who we have, and they will introduce themselves a little bit more later on when we start. So we have with us Sharat Bajpai, Partner in Asia Chief Operating Officer at Ares Credit Group, Diane Raposio, Head of Asia Credit and Markets at KKR, Michael Hui, Bain Capital's Partner, Special Situations in Hong Kong, Chris Wyke, Joint CEO at MA Financial Group, and Jackie Tian, Chief Investment Officer and Portfolio Manager at Flow Capital Partners here in Hong Kong. So thank you for the speakers who represent quite the spectrum of the market. I think just to start off, we wanted to set the context in which we are speaking. We've all read the headlines of what's been going on in the US in the private credit sector. And I just wanted to understand from each of you, from where you sit in Asia Pacific, what the real picture is on the ground. What are the fundamentals we ought to be focusing on? So maybe we can start with you, Michael.
Thank you, Michelle. Let me just give some context of what we do first. Bain Capital Special Situations. So we started investing in Asia, Bain Capital 20 years ago, and around 10 years ago, we saw this huge capital gap that cannot be fulfilled by traditional bank capital and PEs. And so we started our special situations business in around 2014-15. Since then, it has been one of the fastest growing strategies in our platform. And today we have a group of 50 dedicated special sits investors in Asia. I think that makes us one of the largest human footprint for this strategy in Asia. And Asia remains 40% of what we do globally within special sits. So this is really our home market here. Many people, when they hear special sit, they think we are a distressed investor. In fact, distress is only 10% of what we do, and 90% of what we do are really focusing on bespoke capital, often in structured format, that are offered to fill specific capital gaps not satisfied by banks or PEs. So just getting back to your question, Michelle, I think all these headlines that we're reading about, like private credit, like what's going on in the US, right? Actually, that's widening the space that we can play in Asia. I think just anecdotally, we are talking to a number of companies that have approached us that say, like previously they have been engaging in conversations with, direct lenders, like sponsors that have a US root. And now like those IC discussions have slowed down. And so they're looking for more like creative solutions, right? So they have approached us. I think just in general, if you see environment where there's a huge divergence between credit and equity market, right, which is what we are seeing now. The credit market seems to be tightening a bit, and then the equity market seems to be quite buoyant. That naturally just create a wider space for the in-between capitals, the hybrid guys, like to come in and play, and that's what we are doing now. So we're quite constructive with the current opportunity set, although we are obviously like very cautiously optimistic about all these development in Middle East, which we think could cause quite a bit of volatility in the market as well. So,
thank you. What about you, Sharat? If you go to you at Ares.
Thank you, Michelle. I think just to provide as to what Michael is saying, Ares, as far as an institution is concerned, we are a global alternative credit institution, primarily focused across the world in terms of many strategies which are there within that umbrella. We are running an AUM of about 650 billion, according to the last count, have got global offices all over. The root is obviously inside the private credit, as what Michael was referring, but we have diversified further. Our real estate presence is also very large now across, and it has footprint all over. We are into private equity, we are into real estate and secondaries and so many other areas which are basically associated in that alternative credit space. So the growth has been stupendous, and obviously, inside Asia, we have consolidated the presence. We have been here inside Asia for last 17 to 18 years. And for the last 6 years inside Aries, we have grown very fast. So I believe, right, we are one of the largest as far as private credit in Asia is concerned. And in alternative credit space also, I think we are one of the more pronounced. As far as the disruption in US is concerned, to get a little of the perspective, the total global AUM, as far as alternative assets are concerned, which was in private credit, was estimated at around plus minus 3 trillion, depending on as to what you include and what you don't include inside that umbrella. And last year, we did the AIMA report, which was quoting the 2024 AUM. And obviously, it is very difficult to estimate the AUM inside Asia, but we were coming at around $59-60 billion. So think about it, right? 60 billion as compared to 3 trillion, we are just about 2%. And obviously, you can think that we are in the infancy as far as the market is concerned. And obviously, what is happening in US is obviously something to watch for, but it provides a roadmap for us in terms of what to do, and it has a live playbook which we can basically play in Asia in order to be cognizant as to what are the risks and cracks which we are seeing inside US, and how can we prepare ourselves inside Asia to combat it and be forewarned. So that's my take on this.
Thank you. So Diane, I wanted to come to you. So in December last year, it was that KKR sort of secured some 2.5 billion in commitments for your Asia credit fund. But generally speaking, just to understand, who are the biggest allocators to this space? And from then on, how do we then use that to sort of estimate investor sentiment and outlook for the private credit market in Asia?
Thanks, Michelle, and thanks to Deal Street Asia for having us, and then actually my colleague earlier. So maybe just to put it into perspective, KKR, we're obviously very well known for private equity, but actually the biggest asset class within KKR is credit. So we have 290 billion globally. We moved into credit globally because we actually saw exactly what Michael said, a real gap where not everyone wants a controlled buyout and company need capital. That's exactly the same reason that we set up our Asia, and we have a private credit and a liquid credit business. So today in the region we have 10 billion. Might sound small versus the 290 billion, but actually our Asia credit business we see as one of the fastest growing areas. I think our big advantage as well, like my peers, is we've also been in Asia for 20 years. And that's very important, and across 6 key regions and 9 offices, you need to be local in Asia. And so that's really why we moved into it. We started our first fund in 2018. We're now at the second fund, as Michelle said. I think we are very excited and very grateful to all of our LPs, and we as a team are very excited that we got to 2.5. That is more than double of Fund 1, which was around 1 billion, and also was the top end of our target. So I think what we saw during that process is a couple of things. We had a very strong re-up from Fund 1. And so I think everyone who invested with us in Fund 1, has been very, very happy about what they've seen. What I think is interesting in Fund 2, so actually the Fund 1 investors only represent about just under 40%. So actually to get to the 60%, to get to the 2.5, we needed 60% of new investors, which by the way, I think as all of us up here know, is no easy task. And really where we won is probably with large sovereign wealth funds and large pension funds. And most of these larger allocators don't typically allocate to a first fund. They really want to see that the fund has proven itself, the team is together, the team is working very well. We obviously had been speaking to them the whole time, and were able to convert most of them into Fund 2. I would say, and we'll touch on it later, we didn't convert on everybody. And actually what was a negative was geopolitics, and then it also turned into a positive. So certainly after Liberation Day, and I think people understanding the outcome of that, what really helped is people now really believe that Asia was decoupling and Asia was truly a diversifier in a portfolio. And that we really saw a real pickup, I would say, in our fundraising second half of last year, where basically LPs who came in wanted the diversification. They're obviously very sophisticated LPs with very large private credit portfolios. They also understood that we were able to generate a real premium on a risk-adjusted basis. So not only was our premium higher, we were also able to deliver what I would say is better risk, typically lower leverage, better covenants, better step-in rights, particularly versus if you think about the US direct lending market, and track record and your ability to originate, because this is still a brand new market. I think we never come across each other really, and I think that just shows you how early this market is. So I think the opportunity set, both from deployment and from the investor base, I think we were only touching the surface of the opportunity.
Thank you. So Jackie, if we could come to you next in the mid-market segment, it's quite a little bit different. I mean, what are you seeing in terms of, the where you sit? How does it still remain attractive?
Yep. It's an honor to be here, first of all, and thank you for inviting us to be on the panel. So my name is Jackie. I represent Flow Capital Partners. We're an emerging market manager in town, homegrown in Hong Kong, family office back. So we operate in the mid-market credit space. So mid-market, what we call mid-market, is really between 15 million to 50 million in terms of deal size. And we are a senior secured lender in this space and has been operating in Hong Kong and North Asia since 2019. For the past 6 years, we have deployed over $1 billion in capital across 30 plus transactions. And what we can say, the attractiveness of mid-market is, first of all, that these are bilateral transactions that we have negotiated. We usually know the borrower, the company, and typically the chairman of the company very well for many years, and we are usually the first one they get called. And through our relationship with the company, we are able to understand the capital needs of the company, as well as when there's a capital requirement, we can provide certainty and size and commitment to the company. And that's very important to the mid-market borrower. And lastly, what I want to just say, compared to kind of a transaction in the other part of the world, is that we're in the mid-market space where we are typically lower in terms of LTV, right? And we have senior secure package across variety of pools of collateral. And third is that usually there's corporate guarantee, some sort of personal guarantees to a certain extent. So there's a strong alignment of interest between the borrower and the lender side. So in a downside scenario, when push comes to shove, right, we do get resolved in a really orderly fashion, and usually the loss ratio is very mitigated. So for example, over the last 6 years of operation, our loss ratio is only around 0.8% on a $1 billion deployment in size.
Thank you. Chris, coming to you next. So from where you sit, I understand in Australia, but I'm based in Australia, but you're heading into these markets here for investor capital. How does it still present as an attractive proposition?
Thank you. I'm obsessed with credit, and I started off restructuring it, working it out through the financial crisis, and this market has just blossomed really since about 2010, as everyone figured, we can't put any more work to distress because rates have gone to near zero, so the banking regulations are changing, so let's all set up private credit funds and pick up the pieces where the banks should be lending but can't anymore. And we are very, very Australia centric, and we've sort of, as we were talking on the panel, we sort of snuck into this conference as private credit when it's often like private equity and other private markets. So for me, I think it's very important to frame what is private credit. Like, a lot of people have spoken on this panel about leverage, return per unit of risk, but with our obsession with private credit in Australia, we have focused on building an ecosystem around trying to look at every single sleeve of private credit, where to play, and what makes the most sense per unit of risk. And they're broadly 3 types, and it's really different to the rest of Asia. So we've got about 15 billion under management in Australia, and we are very, very Australian focused. We do a bit in the States, but you've really got 3 broad categories of private credit. And the guys next to me, they're really, really big in terms of needing to put a lot of money to work. We'll do small deals and we will do very big deals. But the 3 broad categories of private credit are, you've got your real estate, real assets, big chunky long-term assets, where they've got a long life of asset, physical security, and you can lend against it. So everyone will understand loan to value and real estate. The second asset you've got is corporate loans, and they can be split into two pockets. You've got corporate leverage loans, where you typically have your buyout firms wanting a higher degree of leverage to supercharge their equity return. And then you've got more traditional bank-style deals. And then the third area of private credit that you've got is asset-backed lending, huge pools of loans, large pools of loans. We're probably one of the experts of that in Australia. We do all three. And the Australian market is very, very different to the Asian market more broadly. What has led to the creation of the private credit opportunity in Australia, and I think the US and many parts of Western Europe, is the bank regulatory change forcing lenders out of doing certain loans. And it's very rare that a massive financial market opens up in which you can lean into and grab market share and deploy money and not misprice risk. That's really rare. Those circumstances don't often exist. And interestingly, though, in Asia, I don't think it's the same. The Asian banks are very, very healthy. And the opportunity set is, I think, a bit different. But we focus on all three of those areas. And the previous question around what's going on in the US, the tech and the structure there is a whole different ballgame. But I think the investor base finds the asset class very appealing, aging demographic, stable returns, so on and so forth. And you can really, if you understand credit and you're obsessed with credit, you can really understand the outperformance unit of return per unit of risk relative to liquids and listed. And that's what gets me really excited about it.
Thank you. I guess this is a good time to take one question from the audience. I think as with other earlier panels, please, if you have a question, scan the QR code and we'll take it. So at this point, one question is, why should a foreign investor delve into private credit in Asia rather than in the US? I mean, apart from the different structures. Would anybody like to take this? Maybe
I'm happy to, since we've just finished our fundraising. Look, I would say the first thing is your own portfolio. So you really need to look at your own portfolio. How does credit sit within the overall portfolio? What I think is attractive about Asia, what I think is attractive first about private credit is it is consistent, durable income. Now, you do need a diversified portfolio, and I think that diversification you're going to see is very, very important as you look at the performance of different private credit GPs. But if you've assessed your GP and you're comfortable they have track record, you're comfortable they can step in, because credit is about getting your money back. We don't get the upside like you get in the in equity on the performing private credit side, which is where we focus. So I think diversification is key, and it gives you that durable income. What I think is interesting about Asia and why it's helpful within a portfolio is the diversification point. We actually do a combination of private credit as well, just like Chris. We do senior direct lending. We do junior debt, which we call capital solutions. We also do asset-backed finance, and we also do private IG. So that's a range, but certainly a lot of that is cash yielding. So it does give you the durable yield that you're looking for. It gives you the diversification versus your portfolio that you certainly may have in US and Europe. And there's been very clear correlation. We've been able to show that actually the correlation of Asia to US and Europe is continuing to reduce. And that is because Asia is decoupling. So the intra-Asia trade from a macro perspective was 47% in the 90s. It's now at 60 to 65%, we'll get to 70. So that is just showing you the diversification that's going on. And then secondly, because there's not a lot of players, there's not a lot of competition. So actually we tend to get low, we can give lower leverage, we can give much better terms, we have the ability to step in and stronger governance. So that's why we think on a risk-adjusted basis, it's a very interesting place to play. And that is certainly what our LPs saw when they came into the strategy.
It's really interesting. We have two institutional partnerships, one in Asia with CMBI, where we're deploying into partnering with them on the raising side, and we deploy into Australia and the Asian region. And then we have another in the States with SMBC and Monroe. So we get to see the value pockets between the two markets. I think the US is a lot more saturated. Where you get better terms and conditions in the US is in the middle market, typically, where you can have tighter covenants. The business model for private credit in the States has been, from a manager's perspective, really strong economics, because a small team of 3 can underwrite the deployment of $500 million into one leverage loan. And that's really good unit economics for the manager. And that's become very flooded, that market space. And so I think in the US, you've got to go hunting for a lot more bespoke return per unit of risk. The big end of town has been disintermediated a lot by a race to the bottom on terms. And I think throughout Australia, in particular, Asia Pacific, you can get better terms, and it's not it's not as difficult to find the deal flow.
I would supplement what Diane and Chris are basically saying. Essentially, private credit at 2 decades ago was one product store in terms of basically distressed asset and non-performing loans. But look at this particular panel, there is so diversified, and we are not even talking about infrastructure and all the other match financing and all the other types of financing which have gotten into this particular umbrella. The second is Asia is a growth market. There is a whole lot of demand for the capital. And the banks, they do not occupy the whole space. There are many, many isolated spaces where the banks basically in terms of buyout, leverage finance or the other characteristics, they are basically found lacking. As Diane said, right, there is less competition inside this arena in terms of basically structuring, because you have to be very close to the knitting. Local origination definitely helps. And that is why the type of deals which were available, the margins which and spreads which are available as compared to the other places, obviously that is helpful. Diversification is also the key, but not to be there in Asia for any particular large asset allocator. I think probably they won't be able to catch growth, and it will be a little too late when this particular market starts running. So I think there is definitely an imperative case for the people to be allocating inside Asia when we are at the cusp of the growth.
If I just make one more point on this, I think a lot of people, they talk about Asia as in one block, right? But then like, if you actually look at Asia, I mean, all these different countries, they're really moving in different cycles. So a capable manager should be able to get you, you know, like not just more diversification within Asia, but then actually picking the best risk reward within the region, right? Giving you an example, like after COVID lockdown, like Bain Capital Specialists actually decided to step away from China, and we paused completely from investing in China. We were focusing on harvesting what we had in China, managed to get out of a lot of positions with profit. But during that time, what the team was focusing on was pivoting to Australia, and we spent time investing in Virgin Australia. We took the company, we took control of the company through a restructuring process, and recently just took it IPO. So it was a very successful investment for us. That ability to pivot across different cycle and different economy, that just doesn't really exist if you just focus in the US.
Maybe on that note, actually, Michael, if I could come back to you, you know, you mentioned also a bit earlier, just to follow up, 40% of the business is in special situations in Asia. And going back to what we were saying earlier in terms of the geopolitics, you know, kind of impact it's had, perhaps a positive effect. You know, what are we expecting for this particular segment of the market? Are we expecting to see more opportunities in that sense in special sits?
Sure. Maybe I can just follow up with what Sharad just shared, right? I think a lot of people share a lot of statistics about how nascent this market is. Another way of looking at it is, I often say, Asia's GDP is roughly the same size of North America. And if you look at the alternative capital size, right, the size available in Asia is only 1/10 of the US. So of course, this is going to grow. But the path of growing is taken a long time, because oftentimes you actually need some crisis for it to happen, to widen the gap, to have that divergence that I just talked about, right? If you look before GFC, like who has been active in like the market that I operate in, which is this in-between special sit, strategy, right? Those who were focusing on this were the like of Goldman, Lehman, like maybe Standard Chartered, like some of these banks, prop desk. GFC came, and then like there's this huge retrenchment, right? And then right after that is actually the best vintage that a lot of us actually remember. And it was actually the hedge fund that were trying to play that. Now, unfortunately, it's actually very hard for hedge fund to do this because you actually need, this is very talent intensive in the sense that you need people that knows credit, you need people that knows equity, you need transaction counsels in the deal team, you need structuring people, right? And so like for hedge fund without the capital permanence, it's quite hard to do this like on a scale basis, right? We were very lucky. We came in around that time and sitting on top of our PE business, which already have been operating in the region for 10 years. And so we have that backbone to support us. And what we decided to do is to actually build a regional team that allows us to pivot, as I just shared. And just fast forward to today, right? I think the capital demand now is just a lot more nuanced or complex, right? Like back then, you don't really have all these, cross-border M&A. You don't have a lot of these like geopolitical concern, right? And like sponsor activity was actually much lower. Now you also got a lot of founders who are a lot more aware of cost of equity, right? Like you almost never hear founders talk about cost of equity, like 15, 20 years ago. Now everyone knows that. So I think everyone is looking for these like in-between creative solutions, right? To provide flexible capital. And just lastly, I want to address the point on real asset. A lot of people talk about, digital infrastructure. I think like probably everyone here has some involvement in it. There are other real assets that could be very interesting and asset-backed opportunities, like Chris said, in Australia. Not just in Australia, but then in general in the region, right? Aviation, I think, is very interesting. The number of like passengers growth is just staggering in Asia. 80% of people still haven't flew on a plane before. And music royalty, IP, is something that is very interesting. I mean, the administration of that is really backward. It's still like relying on paper. That's another piece, right? There are a lot of these that I think people are just not paying attention enough, but then are just poised to grow.
Yeah.
Just a quick, in terms of the question around what is the geopolitical going to do to the world of private credit? And this is a point, I'm interested in what the other panel members think about this. This is something we're debating lifetime at our investment committees right now, which is, would you prefer a lower risk loan, more covenanted, with back leverage on it? Or would you prefer to get your return by walking up the leverage of your exposure with less terms and conditions? That's a debate since time began, probably on credit. But what the geopolitical is doing right now is morphing, at least from our investment committees, is morphing us to saying, I would prefer the safer loan with the back leverage, because, I mean, we've had COVID, one war, another war, oil shock. It's just the only certainty now is that there's uncertainty, and the geopolitical, I mean, you can't make this stuff up. It's just this news cycle. And so how does that translate into the way, again, obsessed with credit, is when we run our scenarios, there are so many unknowns. So we go very much for the geopolitics, the way it's impacting that we're thinking about this is high quality loan and manage your back leverage more carefully and really step down the risk of the loan, but generate the return through the structure.
Right.
Yeah, we also have a similar philosophy, which we call ours high grading, where I think you can actually go up the quality curve. Also, to touch on Michael's point, what I think is so interesting about Asia is private credit is, I think it's less than 0.1% of all the capital provided in Asia. And I think a lot of people think Asia outside of Australia, these are small companies. Our average EBITDA is 200 million. We actually just announced 2 weeks ago an investment of 820 million US equivalent into a group called Samsung SDS. This is the IT tech services platform of the Samsung Group. It is also publicly listed. It has an 8 billion market cap, roughly a 900 million EBITDA business. They were still seeking our capital to help them with the AI transition, help them actually also to do M&A, actually help them with funding for AI. So even these big, large companies, there is significant opportunity. I don't think you have to go down the quality curve in order to be able to do this. And so this alignment of our interest, and we get, you know, a small element of cash coupon, but we're aligned on the equity upside. And so there are a lot of these, what we call partnership capital with big corporates, are actually one of the most exciting areas that we see an opportunity. So look, we totally echo your IC, actually,
Right.
Chris.
Yeah, maybe partnerships we can pick up a bit later as well, because we're also seeing a lot more sort of alliances being built between the banks and investment firms. But at this point, Jackie, I wanted to come to you for the mid-market segment. I mean, we've been talking about the larger deals. I mean, what is driving your deal flow, and what's your pipeline looking like in a sense?
Yeah, so for the mid market, actually, we've seen, because we're homegrown managers, so significant deal for coming from North Asia, particularly Hong Kong. And there's a few segments that's very interesting from a pipeline and deal sourcing perspective. One is the real estate sector and construction related sector in Hong Kong. There has been a retrenchment of the banking financing to this sector since the downfall of Chinese real estate industry in general. That's creating a lot of pain to mid-size, small-size developer, invert to some of the small cap listed developer in Hong Kong, not able to get financing, and sometimes to the extent that there are capital being pulled by the banks to some of their project, right? So that have generated significant deal for us. For example, last year we have done 4 transactions to resi project in Hong Kong. These are top tier asset quality from our perspective, like very close to MTR, you know, mid market, like small size, unit size, highly liquid, mass market, right? So some of our product, in fact, when they launched on the weekend, they actually fully sold out. And the underwriting and LTV that we have able to do on those deals are sub 40% from RV perspective. But then on the mark to market today, after the Q4 recovery of the Hong Kong resi market, it's actually even lower. So that's one segment is very interesting for us. And second is that we do see, because Hong Kong is in the crossroad between China and outbound M&A, so we do see a lot of companies that are coming to Hong Kong for financing, for expansion overseas. That has been a really interesting trend for us, and we have seen increasing company that has never been issued or getting financing from a dollar space before, but they do have assets elsewhere where we are able to underwrite the value of the asset across different segment market, so that can provide a holistic solution to the company, so that they can use the capital to expand their factory or build out their business overseas. And just last point, where kind of on the data center AI infrastructure side, we are seeing increasing demand on the AI data center side. So there's 2 segments of that. One is on the kind of data center infrastructure side. There's also the AI computing, which is on the GPU financing side, right? So the 2 players are slightly different, and we have been investing a lot of time to study and get up to speed on some of the space. And we have looked at a few opportunities on that space, which is really interesting from a risk-adjusted perspective.
Thanks. I mean, the other thing that we were looking at, I mean, since we are sitting here in Hong Kong, we were looking sort of northwards towards developed Asia, North Asia. And I think one of the things that we've been told is sort of, for example, the buyout boom or the M&A boom in Japan, in this part of the world. I mean, to what extent, you know, do we see private credit sort of applicable to that particular boom in that sense? Maybe, Sharad, you want to take that?
I think, Mitchell, obviously, you know, one thing which is very much to be thought about is that any dispersion or volatility obviously creates opportunity. And the geopolitics is one, the tariff issues are the other, the third order things which may flow out in terms of the transmission into the economy with respect to the oil crisis and gas crisis and all the other major elements which are coming from the Middle East. So that is another area where things can basically get a little here and there. The amount and the demand which will come inside Asia, and you're talking about Japan, obviously Japan is impacted. Most of the countries in Asia are impacted in a different way, and that is because of the uneven monetary situation which is there within various countries. There is also a disparity in terms of the strong borrowers versus the weaker borrowers, right? There is a strong set of top 50 or 60 companies in Asia that can access bank market, capital market, or anything of that sort in a jiffy. But then there is a whole lot of, about thousands of companies which will be struggling, and I think that particular capital will be stopped. That is where the private banking market will step in and need to play. The amount of opportunity, as Diane had mentioned, is so huge that obviously it's basically a cook's market in terms of what you are basically trying to customize and what sort of structure downside, as well as in all the other protections which you are building inside that particular whole structure. So not only Japan, but I believe across Asia there are going to be all sorts of opportunities inside the distressed space. I think we are going to be very busy in the third quarter and the fourth quarter given what is happening. But obviously inside the sponsor financing space, inside corporate type of lending, which is there in terms of both middle market as well as the large corporates, as Diane mentioned, obviously inside, say for example, infrastructure and all the other associated areas, there is a whole lot of opportunity that can be harvested across Asia.
Right. Yeah, and I'm happy to add quickly. I think the other thing that we've seen is private equity is obviously taken off in Japan. What you've also seen is the Japanese banks are obviously very liquid, but they have reduced their leverage levels post-COVID. So actually they used to be at very high leverage levels. They've come down because what they're trying to do is create structures where they don't just have to sit, all of the asset has to sit on their balance sheet. They're trying to syndicate them. As they've lowered leverage levels, there's a real opportunity for MES. And there's not a significant onshore MES market. There is some players, but not large. And so I'd say that that's been a key area for private credit to really play, backing the sponsors. And then I also agree with Sharad. The other area that we see is not all corporates want to sell their businesses to private equity. So those corporates that want to retain control, that's where we can provide a capital solution. And so I'd say Bain and ourselves have certainly been very active in that area. So I'd say it's probably those two key areas we see.
Right. I just wanted to understand, just to follow up though, as global firms, how different is the underwriting for, say, a company or buyout in Japan, Korea, in this part of the world, in Asia, versus the US and Europe, given the differences in the markets, given the differences in governance and timelines and so on. Whether, Michael, maybe you want to take that?
I think in terms of the underwriting, the standard is actually quite similar. I mean, we run a global IC, so I don't think the standard is any lower. I think the challenge oftentimes when it comes to underwriting capital solutions deal or special situations deal is that what Chris suggested, right? Like for every unit of risk, what exactly is the return that you're taking, and then standardizing the unit of risk, right, is actually not easy. When you move across the cap stack, you can have like equity investors that actually knows equity spectrum extremely well. They know all the recent deals. Same for credit investor. But then when you actually like move between, and then you need to like adjust your structure like during the conversation, right? How do you actually evaluate whether the, let's say, 14% fixed contractual return on your pref is actually the right one versus the 2.5%, like penny warrants that you are getting, right? Like that combination is the right one. I think that is oftentimes the challenge. And having a global IC is important because then that actually aligns all the IC members on the relative pricing or attractiveness of deals in Asia, which goes back to the earlier question of like, why do people actually should bother investing in Asia? Because Asia actually offered you more choices in terms of that spectrum of risk reward. So,
I think at this point there was one audience question. Does anybody on the panel provide private credit to software companies in Asia? And how does one secure that?
I'll answer that.
Mhm.
No.
But to be fair, we don't have a lot of software companies. Actually, what you have seen private credit lend to and private equity be very active in is tech services and business process services. So it's a different issue that we need to think through. And actually, if you look at the Indian equity market, for example, it's really those sectors that have really, really suffered. So we are looking at them. We don't have very much exposure. I think we have one portfolio company in tech services, which we feel very comfortable about, but it's that issue that I think you need to understand and the impact of AI.
I think the general nature of the market inside ACI is that we are closer to the cash flows, we are closer to the collateral, and the underwriting as far as the goodwill is concerned is considered low as compared to, say, for example, the developed markets which are there in US and Europe. By corollary to that, anything which is there in software companies, which is mostly comprising of the goodwill as compared to the hard asset as well as the cash flows, probably that particular component is lacking. That doesn't mean that in future this whole area will be expanding, because as the market develops, the goodwill is going to increase. There is going to be more M&A which is going to be there, and you will have to value the goodwill inside your books. The trick obviously is, and obviously that's when I go back to the first, we are getting benefited in terms of what the learning inside the other markets are. Obviously SaaS is going to be very different in terms of its nature as well as lending as compared to what used to happen in the previous years. The moat needs to be really very well examined. The type of an equity which is covering as far as debt is concerned needs to be looked at, and obviously the triggers and monitoring needs to be very very different as compared to what we are thinking. The AI risk is obviously present in each and every IC whenever we are looking at it. I believe it is true for each and every participant who is going to be there, and that particular risk is difficult to quantify. But in case one has thought through it and looked through the particular parameters of the business, not just the numbers and what the forward looking scene is going to be, and probably has stressed and put in sensitivity analysis and really arrived at what can happen, go wrong, and how will we be protected, I think probably the people will be covered.
Despite my flippant answer, I should probably follow up with because. So no, because what is the key thing that we are grappling with on the underwrite of these companies? And it is as follows. Our mantra in credit, as Diane said, you don't get any upside, you get your contractual return, and that's a good day at the office, and you go home and you protect your downside. And our terminology is, it's about avoiding losers, not picking winners. And the issue that you've got is the AI dividend. Miraculously, I hope the firm that audits us one day turns up and says, by the way, your auditing fees have gone down because we're using AI. Do you think that's going to happen? Maybe, maybe not. But this is the heart of the issue. Software companies, their whole pricing model is going to change. The whole cost of delivering their final product is going to change. The utility of their product in a new world order is going to change. The risk is, who breaks first amongst their competitors and their peers? Who changes their pricing model to their customers first to say, it's actually a lot cheaper now to perform what we're going to do. We're going to lower our prices. We're going to try and grab more customers. We're going to try and take market share. And it is not our job to pick who the winners in that game are going to be and who the losers are going to be. And this is why there's that crisis of confidence that's going throughout the States right now, where there's a large amount of software and innovation. You can't necessarily see yet from a credit perspective, and you don't get the upside of the equity return, who the winners are going to be and who the losers are going to be. So it's a very exciting and dynamic evolution going on right now. But from a credit perspective, we are no upside, downside protection, avoid losers, don't pick winners, and it's really hard to price and figure out your way.
That should be on the wall, avoid losers. I mean, perhaps we could segue right now into the last part, just to understand as the market continues to grow, as I'm hoping it will, as I think we all hope it will. To what extent, when do we expect it to become a mainstream sort of asset class? But also, what are the implications of that with this expansion? In terms of market discipline, in terms of the competitive landscape. Maybe we could start from Sharad. Yeah.
I think ACI is not one particular market. We have always reiterated in private equity panels as well as in private credit, and that we have talked about it. So the different countries will be evolving in a different way because of the behavior as far as the local regulators are concerned, the way banks behave inside this, the local infrastructure in terms of credit develops, the type of an ecosystem getting created with respect to credit rating agencies, or say, for example, the type of due diligence agencies which are there, presence on the ground, and how costly it is to do business over there in that jurisdiction, because of the repatriation risk, currency risk, and all the other risks which are associated with it, right? So doing business in Asia is not easy, right? We need those type of people who know their nitty-gritties, have been closer to the market, have gone through the cycles, and have seen a lot in order to basically think about as to when they are structuring the asset and putting it on that particular table, right? So that's the first point. I think coming back to as to what you are basically saying, probably the developed markets, there is a whole lot of demand which is there from the investors in order to invest in those particular markets, and they are developing in the right fashion, but with a different set of products. So sponsor financing is basically coming back inside the developed markets. Obviously, the special situations, it is the need which will be coming and which we talked about probably inside the developed markets, and it will become intensifying as we come basically to the later part of the year. Asset-backed securities, as Chris talked about, that is going to be there all over. What SME financing is, there is a whole lot of gap inside not only Hong Kong market, but all the other markets with respect to the appetite for this type of capital is concerned. Obviously, it means we are the large managers, we do all sorts of credits inside. So for us, dwelling in $15-20 million doesn't make sense. We will be there at around 100 million plus, but obviously there will be enough managers who will be dwelling inside this. So lot of opportunity, but each and every market will take its own space. The developed market will evolve differently, but the developing market will also find great opportunities which will be basically easier to harvest.
So Jackie, the sub 100 million, as Sharat was saying. Yeah.
Yeah, exactly. So we operate at a slightly different scale, a lot smaller in size. But for economic to be make sense for us is that we gotta drill down into the one single market. So what that means for us is really just Hong Kong and other part of developed Asia market, right? So we're highly special in the region, and for us to be competitive in sourcing our continuous deal flow, right? So we got to be across different industry, different asset class, and in fact in different background of the borrower to a certain extent, so that it gives us a diversified pipeline. So we do see a strong pipeline from our current list of deals that we're seeing. And that trend has been increasing over time as well. And it's mentioned kind of key drivers has been the bank trenching back slowly over time, and that's creating a lot of pressure for the smaller company and getting a harder time to receive credit. And for us, yeah, we're continuing to be excited for the mid market, and for various reasons we just mentioned. And yeah, we'll see how that goes.
Diane, over to you. The thing is, we're just trying to figure out how do you differentiate yourself, particularly when we see a lot of the top PE firms have their own credit arms, as it were. Does it complement what you do or compete?
Yeah, so first of all, I would say I totally echo Sharat, and also Michael, there is no such thing as one Asia. And I also echo Chris that actually the most developed market is Australia. So actually today, I'd say 40% of our deployment is in Australia because it is the most developed. But the rest of Asia is not, private credit is not going to grow because the banks pull back. We don't really see regulatory change. But actually, the reason private credit will grow is because the amount of flexible capital that's needed. Because banks are like 80% of all the capital. So if you compare that to Europe, that's 50%. So I still see most parts of Asia as probably 10 years behind Europe. I also think if you want to have a Pan-Asia strategy, and I also echo Michael, we do think you ideally want a Pan-Asia if you're playing in Asia outside of Australia, because you want to be able to pivot. All of the economies are asynchronous. So in order to do that, that's a huge infrastructure. You need people on the ground in every single country. I was just in India at the beginning of the week, meeting various corporates, and they were saying to me, "But Diane, you're not Indian. How do you understand me?" I need to speak to people that understand India. And by the way, that's not just India. You go to Seoul, you go to Japan. And so that local platform is absolutely critical, number one, to build relationships, and then obviously understand how to structure, how does the regulation work. So I think that infra and all the key players here, like Ares, Bain, we have big platforms. We've been here for a long time. So I think it's going to take a while before you get to what I would call more of a flow market, which is what you've seen in Europe. So that's why I think certainly the way we look at it is there's at least another 10 years of this risk premium staying. And it's going to take a while to go away. And so I think that's very interesting. Where the value add comes from is sponsors absolutely have heard of private credit. But the way that we've seen the evolution is first it's the big global guys. And by the way, it's the big global guys that started in Australia. Now we're seeing the mid-market guys go, oh, if the global PE guys should do it, now we'll do it. So now in the next country for us, which is probably bigger on the sponsor side, is India, because you're seeing a lot of controlled buyouts. There are certain regulatory issues there. But once again, you have to start with the global guys. And by the way, just because you've worked, even at KKR, if you've worked with our Australia team, it's still different to working with our India private equity team. So each country so you have to build that relationship on the sponsor side. On the corporate side, and this is really the value add, I would say, of KKR, is when we're going in pitching to a corporate, we're not saying to them, you know, our product is private equity. We're going to them and saying, what are you trying to achieve? And actually, in some cases, it might be an infrastructure deal, it might be real estate, it might be a controlled buyout, or actually it could be us, where you keep control and we can provide you. No corporate goes out looking for private credit. They've never heard of it. So they're working with KKR because they're like, oh, I'm going to get value from KKR. And so that's why I would say everything that we're doing in the region is proprietary. But the same is also for the other panelists. And that's what's so interesting about this market. We will get to a point and other people will come, but that's when corporates and sponsors will have been very used to it. So that's why I think this next 10 years is still very interesting for us in private credit.
Right. And Chris, so briefly, so Australia is the market to be in.
Well, for us, I say an unhealthy, so my wife tells me, obsession with credit, where we've just gone really deep. So we employ about 1,000 people in Australia, just focused on Australia. And we're a very interesting business whereby we have a few different limbs, and one of the limbs of our business processes through and touches 1 in every 8 home loans in the country. We process close to about $10 billion a month of home loans through a piece of infrastructure that we've got. And what I love, and where I think private credit has to go, is data, 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 data. I have 139 touch points of data from 350,000 Australians, which informs me around, should I do car financing to a cohort of borrowers by postcode if I can see that postcode is suffering with arrears on their home loans and things like that. So I think it's going to become more and more sophisticated because the opportunity's there, capital formation comes to it, but then you have to be different and you have to price risk appropriately. And I think that's just the data and the information and the analysis on private credit and decision making as more geographies become more advanced is going to become more critical. And then the only thing I will say is that we haven't mentioned the word that should send terror through any credit individual's investment committee, and that is fraud. You can't get your money back if there has been fraud. And I think the private credit industry needs to really focus on geographies that you go into, on the regulations and fraud management and how you diligence that. You can get it wrong at investment committee because what you had to believe didn't work out. But it's unforgivable if you should have spotted the fraud and you didn't. But if you have been defrauded and it's been done really, really well, that's just horrible. And the regulatory environment and the systems and processes around fraud protection, I think, is going to be an area of focus.
Michael, you have the last word, as it were.
No, I fully agree with what Chris said, right? You know, a lot of things that we're reading now about like negative things about private credit, right? It's not a private credit issue. It's a diligence issue, and it's about margin of safety, right? Like if you have done the thorough diligence and leaving that margin of safety, right? Like those kind of things should not happen. Like Asia has not actually seen that huge influx of capital like maybe in the US, right? Like I think we all share, we seldom actually bump into each other on deals. So like we don't see that kind of competition or pressure to deploy. And so right now, like I think at least for the next couple of years, is still going to be relatively safe for this space. Like, unlike maybe like in other markets that like people are more worried about. So.
Thank you. So much scope, but diligence it well. Thank you so much to our panelists for this session. Thank you.